Ava prescribed me some personality tonight. Usually at these webinars, supposedly I'm very dull.
He's like, hello, I'm August Biniaz, and I'd like to think about it.
Well, I on these serious matters like investing, lawyers and corporate structures, offering memorandums, all this stuff, you want to be serious.
But it all comes down to us. We're building wealth. We're helping people build wealth.
Absolutely.
So it is fun and exciting. So I said, get that personality out.
Absolutely.
Let's have fun with this, and people will get ramped up and excited with us.
Definitely. Yeah. So it's 6:34. People have trickled in. We have Tyler letting people in, our marketing director. So we'll start the show. 3, 2, 1. No, just kidding. There's no 3, 2, 1. We'll just go ahead. So yeah, welcome everyone. Thank you for joining us tonight for this one-of-a-kind webinar. I hope everyone has enjoyed their Labor Day long weekend. I'm August Biniaz, CEO of Canadian Passive Investing and an educator with CPI Academy. A little bit about myself. I'm passionate about educating our network so they can make informed investment decisions. Through CPI Academy platform, we bring on experts to educate our viewers and add as much value as possible to our partners' investment journey. Mm-hmm. So, I'm joined tonight by my wonderful co-host, Ava Benesocky. So take it away, Ava.
Hello, everybody. Thank you so much for being here, and thank you very much, Mr. August Biniaz. I'm Vice President of Canadian Passive Investing, and I'm also a partner with the Vancouver Real Estate Podcast. I'm also extremely passionate.
Wow, you're really passionate. There's a lot of passion there.
Yeah, okay. A lot of passion.
You stole my line, by the way.
It was my line.
Okay.
About educating and benefiting others. Okay, so as a real estate now for a decade.
Real estate agent, right?
Real estate agent for a decade now. I have firsthand experience with the frustration of real estate that real estate investors face when trying to make crucial decisions and not understanding the fundamentals of investing. So we are I know for a fact that we're going to be providing immense value and lots of useful content that you as our viewers can use to build wealth and create financial comfort.
Absolutely, and that's the key,
yeah.
Financial comfort. Jillian was speaking on that matter before we started the podcast while people were coming in, but that's the key of having that financial comfort, having the choices and
yes.
the ability to be able to give back. And that's, there is something psychological about giving back, and having financial freedoms allows you to do that. I'll stop blabbering because you told me don't blabber, okay? Just get to the point. Okay, so very well said. Thank you. So tonight we have incredible guest speakers for you. As I mentioned earlier, I'm sure everyone knows free consultation from lawyers is near impossible, okay? So now imagine combining expert lawyers from Canada and from the US. And in my opinion, they're probably the best at what they do because I found them knowing that they're best at what they do to bring them on.
Yeah, you guys, August has literally been doing his happy dance all week because he's like, I'm not going to be getting a big bill for this tonight.
Well, with lawyers, you never know because I've called my lawyer friend like, hey, how you doing? How was your week? I'm like, oh, great. And then next thing you know, a couple of days later, I get a $2,000 bill in the mail. So, you never know. I'm just kidding. I'm just kidding.
You're making them blush.
Yes.
All right.
Okay.
So why don't we start and get to the exciting part and introduce our guest speakers?
Absolutely.
Tonight.
Please go ahead.
Why don't we let everybody know the...
Yeah, no, absolutely. Just before, please write your questions in the chat box, and at the end of the webinar, we'll get our guest speakers to answer any questions you have, and this is going to be great. So we have attendees from the US, from Canada, people looking to invest, cross-border investments. So this would be great. Any kind of questions you may have. Please take it away.
Okay, so let's start off with Brennan. Tonight we have Brennan Piovesan, solicitor attorney with Farris LLP. He specializes in real estate, structuring partnerships and other investment vehicles, preparing offering memorandums to other public offering documents, security equity, debt financing, and negotiating. Brendan also has extensive experience working in-house and outside counsel for most major municipalities in British Columbia.
Wow.
He works regularly alongside or opposite with most of the major banks, credit unions, and mortgage investment corporations lending in the province. Brennan has strong relationships with many of British Columbia's top commercial real estate brokers, sales, and marketing agencies. Now, Brennan is CPI's Canadian corporate and securities lawyer. We absolutely love him, and we are humbled and honored to have him here tonight.
Absolutely.
So thank you, Brennan. Welcome.
Well, absolutely. And we have our other distinguished guests, Jillian Sidoti, attorney, speaker, entrepreneur, mother, and former college professor. Wow. Jillian has written equity and debt offerings for all kinds of industries, including real estate, biotech, film, software, alcoholic beverage, cannabis, and green tech. Jillian's client list includes Grant Cardone. We all know who Grant Cardone is. And, every time on your YouTube feed, you continue to see Grant Cardone. Tan Merrill of AE's Flip This House. I know that show. Tariq El Musa of Flip or Flop. Bigger Pockets. Everybody know in the real estate investing knows Bigger Pockets. And many other well-known established business groups. Excuse me. Jillian is the author of Crowdfunding Myth, Debunking the Myths Surrounding Crowdfunding. Jillian is the founding partner of Crowdfunding Lawyers LLP, established in 2014. Crowdfunding Lawyers LLP clients have gone to raise over $4 billion in capital. A number soon Canadian Passive Investing will be at. We're looking forward to be working with Jillian as our U.S. securities and corporate lawyer and advisor. Welcome, Jillian.
Welcome.
Thanks.
Awesome.
Glad to be here.
Ava, go ahead.
So, Brennan, it looks like we're gonna start off with you. We're gonna put you in the hot seat here.
Okay.
I put Brendan in the hot seat every week when I call him and ask him all kinds of questions. So he's used to being.
That's right.
Okay, here we go.
Great.
Brendan, could you explain to us the regulation about raising capital? Now, can anyone raise capital from whomever they wish for whatever their business idea is here in Canada?
So the short answer to the question is no. Now, of course, obviously, as with lawyers, there's no such thing as a real short answer. So unlike in the US, we have a fairly complex province by province regulatory system for securities offerings, for public offerings, for raising money, that sort of thing. And while we have some level of national guidance for them, a lot of the regulation is province by province. So the short answer is, as a general rule, the starting point is always that a prospectus is required for any securities offering. And so that, when you think of a prospectus, think of an offering document that would be issued by, Facebook when it does an IPO, or some other large organization when it intends to be publicly listed. Now, the exception to that is if you can find an exemption. And there are a number of exemptions that are frequently used particularly in the real estate market, and particularly in the cross-border real estate market. And the two most prevalent exemptions, or the three most prevalent exemptions, I should say, are, in the first hand, doing an offering under an offering memorandum. And an offering memorandum is, we refer to it as prospectus light. And it's basically a less cumbersome document, generally shorter. Really what it does is it goes through the intention of the offering, what the purpose of the fundraising is for, the ownership structure, various risk factors, and other things like that. And really kind of walks an investor through the various moving pieces in any sort of real estate offering or securities attached to a real estate offering. The second exemption is what we refer to as the accredited investor exemption. Now, accredited investor is a specified term under one of the national instruments published by the Canadian Securities Regulator. And in essence, think of it as meaning a high net worth individual or a company or a family trust that has significant financial and non-financial assets. And really the intention there is, the idea is supposed to be that in essence, high net worth individuals, family trusts with significant assets under management, that sort of thing, are typically more sophisticated investors. They may have a management committee, they may have other oversight, but certainly that they're typically, you tend to find a lot of, for example, lawyers who are investing in deals who are subscribing under the accredited investor exemption, tend to have fairly high net worths, tend to be knowledgeable about securities offerings, risk factors, things like that. So that's the second exemption.
Okay.
And then the third exemption that's typically relied on in this case is a minimum exemption requirement. And this is sort of a bit of an odd creature of Canadian securities law. But essentially it says if you're investing over a minimum amount of $150,000, again, in that case, no prospectus is required. This is a little bit more murky, and it's also an exemption that's not typically relied on because it comes with a lot of securities regulatory filing requirements that are typically attached to prospectus offerings that are quite cumbersome, costly, that sort of thing. So typically we try to stay away from those two. So the two most common ones are the accredited investor and the offering memorandum. The big advantage of the offering memorandum is it opens up the offering to a much wider pool of investors. So the investors who might not qualify as accredited for very specific reasons are still able to invest in deals under the offering memorandum exemption, and issuers are authorized to actually issue to sell securities under the offering memorandum exemption to essentially to any member of the public who receives the offering memorandum, and that makes it a very attractive tool for a lot of issuers because it does require less sort of cumbersome, disclosure requirements, while at the same time disclosing in a very fulsome and sort of thorough manner to the investors, what various risk factors are, what the ownership structure is, these types of things, who's going to be managing the investments, that sort of thing. So it's a very good document that way, in that it gives investors a very good understanding of the prospective investment and that sort of, and allows them to make an informed decision. So
awesome, amazing. So just a couple of quick questions about that I had from you. So and this is the differences in the U.S. and Canada just comes to my top of my mind now, is that you mentioned every province in Canada has its own securities regulation, and what I believe the way it's in the U.S. is just the SEC, so the Securities and Exchange Commission. Is that kind of, do I have it? So it's provincially rather than federal?
That's correct. And with that comes a certain various sort of minute but important differences between provinces as far as the various documents. So, for example, the Ontario Securities Regulator, Ontario Securities Commission. This is a bit of an oversimplification, but essentially says that any sort of advertising pitch that includes, financial statements or financial projections or that sort of thing is deemed to be an offering memorandum. And with that comes certain statutorily required disclosure rights, certain rescission rights to prospective investors. For example, they're allowed to rescind their subscription for limited partnership units, for example, if that's what's being sold for 48 hours after signing up, things like that. So there are small differences, small but consequential differences in how the individual securities regulators across the country deal with various of these issues, which is very different than in the U.S., where, yes, in general, the Securities and Exchange Commission has sort of general oversight over all securities offerings in the country, in the U.S. So.
Great, yeah. And also another item was the two main exemptions that are used. The offering memorandum exemption in the U.S. offering memorandum means something totally different, and we'll get into that in a bit. And the other exemption is the accredited investor. So thank you so much for that, Brendan. I'll turn to Jillian. So Jillian, kind of same question to you. Can anyone raise any money they want for any their business idea, for example, a real estate project in the U.S.?
Yeah, absolutely. So the thing is, real estate actually gets a lot of great exemptions to it specifically from other laws. The United States is a land of many, 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 many laws. And, where Canada has provincial rules for securities, the states each have their own rules as well. But the law of the land is the federal law. And so some of the exemptions that are afforded under the federal law in the United States, which is governed by the SEC, as was mentioned, those are what are called federally covered securities. And so the states can't really make laws that are more cumbersome than those laws. The law is that for those particular exemptions or rules or whatever, the states can't make more cumbersome laws. So that's a good thing. But even when you're raising money in the United States, you still have to pay fees to every single state where you're raising money. That's what they like to do, is collect money, like most governments. So, and that's what they will do. So in the United States, we have laws that regulate the raising of capital. And then we also have laws that regulate what you're raising capital for to a certain extent. But like I said, real estate usually has some really cool exemptions that where some of the rules just simply do not apply because it is real estate. Now, we have an accredited investor exemption. It's called Rule 506, which is under, if you think about the law as a tree, it's under a thing called, so you have the big law is the Securities Act of 1933, which came out of the Great Depression. Then under that is an exemption called Regulation D as in dog. And then under that is a bunch of rules. And the rule we always focus on is one called Rule 506. And under that, if you are an accredited investor, and you're provided the proper disclosure, that is one of those federally covered securities that, where the rule is you can go out, you can raise capital. And if you're advertising, you can only take accredited investors. If you're not advertising, you can take a combination of accredited investors and what we refer to as sophisticated investors, which are people who don't have the same income or net worth as the accredited investors, but probably have some kind of experience that makes them know better when it comes to investing. Whatever the case is, the number one thing you have to remember, whether you're a passive investor or an active investor, is that disclosure is king. And I don't think this is different in Canada or the United States. It's all about disclosure. What did you tell your investors? Did you tell your investors everything that they needed to know in order to make an informed investment decision? And investors, did you receive all the information that you needed to know in order to make an informed investment decision? And what I want to tell all of you is to not shy away from bad news, not shy away from a pessimistic story. If somebody's telling you a terrible story of risk and all the terrible things that could happen, then you kind of want to lean into that just a little bit. Maybe not completely, but you want to lean into that a little bit, because this shows an issuer who's thought about all of the possible things that could happen. And when you think about all the possible things that can happen, you can plan better. And you can put contingencies in place. So don't shy away when somebody says to you, the risk is that we could lose all your money. The risk is, and don't shy away from saying that to people either, because that just shows that you've done your research, you've thought about it, you've thought, here are all the terrible things that could happen, here are all the risks, and brought them to light. And that's really what we want to do. That's what we want to do for our investors. That's what we want to do to protect ourselves when we're out there raising capital. And that's what you want to read when you are an investor. And it sounds counterintuitive, but really that's what you want to be putting out there.
Okay, I think Brendan is back. Yeah, just a quick item there, Jillian. So in regards, a couple of questions that came up. So the way it seems to me is, as far as providing the information, the content to the investor in Canada, and please correct me here, Brendan, is as long as, so for non-accredited investors or accredited investors, if you're using the offering memorandum exemption, the offering memorandum is an extensive document where it includes all the risks and the business plan and all the details. But in the U.S., when you raise from, when you mentioned something to provide them with information, tell us a little bit how extensive is the information, Jillian, that you have to provide to the sophisticated and accredited investors.
It's the same information. Now, there's some people who will tell you, oh, you don't need a PPM for accredited investors. This is terrible. This is a terrible way to conduct yourself. You should always provide, and we call it an offering memorandum here as well. Oftentimes it's referred to as a private placement memorandum or an offering circular. But what you want to do is you want to provide them that big document that says, here are all the risks. Here is what's going to happen. It's just the who, what, where, when, how much, and why of the investment. It's the investment story. And it's a pretty depressing story. Like, it's not a marketing piece, it's a legal document.
Yes.
It's a depressing story of all the terrible things that could happen to your money in the event that these people, or this company goes and invests it and does what they're going to do with it. So that's really what you're getting. Again, it's not a marketing piece. It will probably follow a marketing piece. You'll bring in an investor, you'll razzle dazzle them with your marketing, and then you'll hit them with some cold water, which is your offering memorandum. Now, the offering memorandum is the disclosure document. The real, and I don't know what the equivalent would be in Canada, but the real document that is legally binding are the corporate documents, right? So for example, here, most real estate companies, most real estate funds are LLCs. And so those are governed by what's called an operating agreement. So if you're going to invest in in a company in the United States that is a real estate company, the first thing you really want to do is read that operating agreement and make sure it works for you. Now, if you're Canadian, you really actually don't want to invest in that. What you want to do is find companies that are raising money through a limited partnership. And yeah, there we go. Because the limited partnership gives you a tax treaty. We have a tax treaty with Canada, which gives you a tax advantage when you invest in a limited partnership as opposed to an LLC. And that same tax treaty is not extended to an LLC, unfortunately. It doesn't really actually make much sense as to why it isn't, but it isn't. So as a Canadian, you really want to be looking for LPs because that's where you're going to get the greatest tax advantage.
Yeah, no, absolutely. Great. So another quick, so just for a clarification here. So in the US, if you're using the 506 exemption, you can raise from accredited investors or sophisticated investors, and it's advised best to provide them with some form of a PPM or something equivalent to a PPM, or it's a detailed document.
Correct. Yeah, I would here's the thing. What I always tell people is yeah, maybe you can rely on this rule that says accredited investors don't need disclosure or whatever, but that doesn't mean that the investor can't sue you for fraud if you didn't tell them something. So this is what you're covering yourself against. There's a lot of scary monsters out there, and the government is just the biggest one. The government is just the scariest and the biggest one with the most amount of money to destroy you. But you know who else has a lot of money that can destroy you are accredited investors. So you really want to provide them with all the disclosures so they can never say, but you didn't tell me that. That's really, what we're kind of going for when we're going out there and giving them. It's the best insurance policy that you could ever buy for your business is this document.
So just the last question about this item. So Brendan, when we are using an offering memorandum exemption here in Canada, the investors obviously they don't no longer need to be accredited, but do we have an equivalency of something called sophisticated investor?
No, there's no equivalent here. So the accredited investor is a prescribed category. There's various income and related tests that really deal with kind of the value of your income or your net worth and that sort of thing. And there's various sort of specific tests and there are specific numbers that have to be met in order to qualify as accredited. But there's no category outside of that called sophisticated investor or any sort of equivalent to that. So the idea is basically here that almost by virtue of your income or your net worth, you are sort of deemed to be a sophisticated investor, not as that term is defined in US securities law, but just simply in the sort of colloquial sense.
So if you're using an offering memorandum, you can raise from someone who's not accredited, and they don't necessarily. That's correct.
That's correct.
Necessarily need to be accredited, a sophisticated or whatever else. So great, yeah.
Correct, and we have it's a slightly different scenario. I mean, I think this is what Jillian was sort of alluding to this before too. We have the accredited investor exemption allows you to raise from accredited investors without doing an offering memorandum or a prospectus or any other sort of disclosure document. And so there are instances in which issuers will raise funds from accredited investors only with let's just say they're light on their sort of disclosure of risk factors and that sort of thing, whether it's in the when it's in the corporate documents. That's a concern for sure. It's, as Jillian alluded to, in Canada, it's the same thing. It's, disclosure is the heals all wounds, basically, right? It's the best thing that an issuer can do in order to very clearly identify where this thing could go wrong, what could potentially happen to an investor, and what, and things like what factors are outside the issuer's control, right? If you're buying real estate assets, there's always a risk of expropriation. There's a risk of, various changes to zoning laws and things like that that may be outside of the issuer's control. So,
environmental issues.
Exactly. And so even outside of the sort of prospectus or offering memorandum, requirements, disclosure is still a good idea. And then we take that a little bit further in some jurisdictions in Canada, where there are certain documents that can be put together that are sort of deemed to be either an offering memorandum or what have you. And so there's various kind of, disclosures that are required no matter what, whether you're selling to a creditor or otherwise, and, descriptions of risk factors and, language around forward-looking information on financial projections and things like that that are prescribed by law in some jurisdictions.
Great. Go ahead if you'd like to.
Okay, Brennan, right back to you here. In regards to syndicated real estate investments, what are common corporate structures sponsors use to raise capital? So for example, funds, limited partnership, equity shares, joint ventures, and so on and so forth.
I would say that for income producing assets based in the US, where being acquired by Canadians primarily, or even in a significant portion, the two most common versions are REITs, or real estate investment trusts, and limited partnerships. The real estate investment trusts are the simplest way to distinguish the two, or the simplest sort of difference between them is real estate investment trusts they're single trusts. They tend to own multiple assets, sometimes within a same category, for example, office buildings only, and sometimes within, two categories, although generally not broader than that. And they invest in multiple different properties, perhaps through multiple different jurisdictions, that sort of thing. But it's an ongoing, it's a fund. It's intended to invest in multiple different properties over a period of time. The trust units tend to have a sort of redemption date, so they will expire sort of in essence at some point. Real estate investment trusts are oftentimes, although not always, publicly listed units. So there's in some cases for the publicly listed ones, there's an ability of investors to resell their units on a public market, which can be attractive. And they tend to typically offer sort of lower projected yields because of that, because typically they're sort of, there's a fairly complex governance structure. They have a track record. Like that particular REIT has a track record, that sort of thing. It's a bit different than limited partnerships, which are typically used for sort of, single investment deals. And they tend to be a little bit higher risk. You're not pooling your money across multiple properties, across multiple jurisdictions and stuff, which can potentially obviously increase risk. But at the same time, because of that, the potential return offered on limited partnership interest is typically higher to investors. So that's kind of the standard. And the limited partnerships are great because, as Jillian alluded to earlier, they're essentially a tax flow through. The Canadian investors still have to obtain an ITIN number in the US, and there are still some filings with the IRS that are required. But for the most part, provided that somebody is only a Canadian taxpayer, is not a US taxpayer or US person under tax law, there's no obligation to remit any taxes to IRS. So there can be holdbacks, there can be various other things, filings obviously required, but no tax payable typically. So under the tax treaty between the two countries. Limited partnerships are also great because they're typically nimble. They're each new investment is has been is a single purpose limited partnership acquired for that specific property. It allows you to kind of rejig the deal in each case, perhaps change the governance structure if you'd like. It gives a little bit more flexibility. So that's kind of the general oversight of the two most commonly used ones. We don't typically see things like joint ventures and the like, simply because there are sort of tax consequences. We don't, as Canadian taxpayers, we don't want to, we don't really want to be stuck in a situation in which we've earned income in the U.S. There's some really nasty consequences of that in some instances, and so we tend to prefer to use investment vehicles where we are taxed only in Canada, even though we sort of generally always have filing requirements in the U.S. if we're indirectly owning U.S. property.
Great, thank you for that. So Jillian, same question for you, but in my experience dealing with U.S. sponsors and communicating with my associates, what I've noticed is limited partnership, and I might not be totally right on this, but what I've noticed is limited partnerships are not as prevalent as LLCs. A lot of times sponsors create LLCs and sell the shares of the LLC to their investors. So please go ahead.
Yeah, and the reason why they do that is quite simply because an LLC is much more flexible than a limited partnership. And also in a limited partnership situation, members of the limited partners in a limited partnership cannot take on any management roles whatsoever without ruining their liability protection. So in a limited partnership structure, there's two parties. There's a general partner and then there's the limited partners. The general partners do not have any liability protection. So if you invest as an individual in a limited partnership and then you take on some kind of management role or start acting as if you're more than a limited partner, you're not exactly passive, you're going to ruin any kind of liability protection you have. And if you're an individual, that can be very dangerous. So we prefer limited liability companies because it doesn't matter if you are an active or a passive investor or manager, because everybody's protected the same in a limited liability company. And then you also have so many other advantages with how you run the company, how you structure the tax structure, all of these things. So one of the solutions to get around this, for example, like I'll just say, for example, Grant Cardone, if you're a Canadian and you want to invest in Grant Cardone's deals, well, he's all LLCs. So you're not going to get that tax advantage. So what you can do is you could set up your own entity in the United States, get your own EIN, or at some way or another get some kind of tax ID, and then you'll not have the worries of withholding in investing in an investment vehicle that doesn't have the tax advantages. So because that's really what we're trying to prevent, because in the United States, if you're a foreigner, the syndicator or the fund manager or the company is obligated to have a 35% withholding, because what the United States government is afraid of is that, foreigners will take their money and never pay the taxes. And they're probably right. So they want to prevent that. And so they put the onus on the company to withhold the taxes from the foreigner. And so if you want to prevent that, the way you can prevent that is to show up with a tax ID from the United States.
Great, awesome, yeah. So
okay, so yeah, Brennan, back to you. This question is a follow-up of the last question. As limited partnerships are one of the most common structures used by sponsors to partner with investors, who actually owns the asset? Is it the investor? Is it the sponsor? And can the GP sell the asset and run away with all the money?
So the answer to that is it depends. So typically, the most common structure that we deal with for income producing assets is a series of partnerships, all of which kind of flow out to the ones sitting above it on the org chart, or below it, depending on how you draw your org charts. But typically wherever the property is, there's a U.S. partnership, oftentimes a Delaware partnership, that is the owner of that property. it's the Delaware Limited Partnership that's the owner of that property. And it's the one that takes on the, bank financing. If there's going to be bank financing, it's the one that engages property management companies, contractors to do repairs, all of those types of things. And it's the one that collects rent checks, for example, and, deals with leasing issues and the like. And then, at the end of the month or the quarter or the year, what have you, it flows its income up into its investor partnerships, who in turn will distribute it out to their investors. Now, oftentimes this organizational chart can be multi-layered, can have many layers along the way. So that process might get repeated more than once. But the owner of the property itself is in fact a limited partnership ultimately. So, and it really all that the intermediate partnerships do is act as sort of flow throughs, and they collect money in, and they push the money into the investor dollars into the partnership that's going to acquire the property, and then in turn they receive funds back from the property as they're pushed out by the owner limited partnership.
Great. So a quick question, the org chart that you were mentioning, is that part of the information that gets given to the investors through the offering memorandum?
That's correct. So an offering memorandum would have a complete description of the ownership structure all the way through, including, for example, details on who the directors of the general partner at the Canadian level would be, who the directors of the general partners of U.S. limited partnerships would be. For example, descriptions of material terms of the operating agreement of an LLC which serves as a general partner of a U.S. partnership, and so on and so forth. So there'd be a complete description not only of the actual ownership structure itself all the way through, but key control terms. For example, if a investor alongside let's say there was a Canadian limited partnership, if there was an investor was interested in looking at the offering memorandum for that partnership, and let's say sitting beside that partnership was another investor who had negotiated some level of operational control over the asset, or an ability, for example, to replace the directors of the U.S. LLCs that act as general partners, that would all be disclosed in the offering memorandum, so that the investors have a complete overview, or prospective investors have a complete overview of ownership, governance, management, and so on and so forth, of all of the entities that are ultimately going to raise funds and pool them into acquiring this partnership.
Okay, wonderful. Just to fix something here. And another question that came to my mind for you guys, this is from an earlier subject that we were discussing. Jillian mentioned that when you're talking about, when they're talking about investing in real estate in the US, that real estate securities tend to get certain benefits and relaxed regulation. Is that the same kind of idea here in Canada, or is it across the board no matter what kind of business you're raising capital for?
As a general rule, we don't really distinguish all that much. Now, there's a lot of exceptions to that rule, but there's no particular treatment in general of real estate securities tied to a real estate purchase, let's put it that way. So,
yeah, and I think me and Jillian had this conversation in regards to a fund and a fund manager, and where to run a fund here in Canada, you need to have a fund manager who has certain experience. But Jillian mentioned that in the US it's not as difficult, that the real estate actually gets an exemption not to need a fund manager. Am I correct on that, Jillian?
I didn't hear that last part of what you said. Like, you kind of trailed off for me. Can you repeat that last part for me?
Yeah, no, for sure. I think we had a discussion about this matter before, where real estate securities receive certain type of exemptions from the government in the US. And the question was about a fund, where a real estate fund here in Canada needs a fund manager, and fund manager needs to have certain qualifications, certain years in business.
So that is actually what I was referencing. So, like, let's just say we're talking about a company that, I'm just looking at my cell phone companies versus real estate. There's no distinction between a cell phone company and a real estate company, like a real estate syndication. If you're going to buy an apartment building and you wanted to raise money for that, there's zero distinction in that regard. Where the distinction comes is when you're coming to funds. So you kind of hit the nail on the head there. So, for example, if I wanted to do a fund that focused on stocks, bonds, cryptocurrencies, anything, you know, just throw in a whole basket of things, that's regulated differently than a real estate fund. So a real estate fund enjoys certain exceptions and exemptions from being what's called regulated as an investment company. Investment companies have a whole new other set of rules that they have to follow. But the big but is, if you invest only in real estate, then you don't have to pay attention to the Investment Company Act. You don't have to register as an investment company. You don't have to be a registered investment advisor, things like that. So that's why we like real estate so much, because it just gives us freedom from some of these laws that can be quite oppressive, because the cost of complying with them is really high.
Got it. And Brendan, if you want to add to that, am I correct about this item that if there is a fund here in Canada that under the regulations you need to have a fund manager, and the fund manager needs to have certain qualifications to be the fund manager?
Yeah, that's correct. So as a general rule, if a partnership in BC or elsewhere in Canada is raising funds for the purpose of only being a passive investor in the ultimate asset being acquired here, in other words, it exerts no control over operation, management, governance, anything like that, then there's a risk that it's sort of deemed to be an investment fund, in which case there are certain prescribed requirements, including having an investment fund manager who has to have various qualifications, and there's various filing fees and the like. There's no bright line tests on what management means or control over operation. So, you know, it's very fact specific to the securities regulators, but in general, if for example, a British Columbia limited partnership were simply acquiring limited partnership units at the US level with no, let's just say they were acquiring, 2% of the partnership units at the US level, and they had no rights to vote or anything, which is sort of typical in a limited partnership structure for a limited partner. They had no right to attend board meetings, to perhaps nominate their own director, anything like that. Then there's a risk that they could be an investment fund, in which case there would be various sort of securities compliance requirements, including having an investment fund manager.
Got it. The next question, Ava, some of those we've answered already, but please go ahead. And
yeah,
I think the last part of it is pretty important.
Of course. Okay, so Brennan, you represent our group who raises capital from Canadian investors to invest in the US. Our accountants have created this intricate structure for our investors to be able to invest in the US without having to worry about double taxation. How are Canadian investors protected when the asset is owned by a US entity?
So do you mean protected from the sense of sort of ownership and operation and governance?
More of like fraud or somebody running away with the funds. That if the asset is owned by a corporation in the US and our investors are Canadians, how do they get a peace of mind, that an American kind of company owns the asset? So if you could just...
Yeah, and so this is where you kind of need to be very careful about the sort of chain of partnerships and what levels of control and oversight are exercised through them, whether or not sort of key concepts around, for example, the ability to replace directors, the ability to remove a general partner at the US level. Those types of rights are typically, they have to be negotiated. It has to be very careful to make sure that there's some level of control, particularly, mostly what we're talking about is instances of fraud, misappropriation of funds, things like that. There is always a risk in the sense of, as a limited partner, as Jillian mentioned before, by definition, you have control over the ultimate owner here. So if I invest as a limited partner in a BC limited partnership or a BC limited partnership then acquires partnership units of a Delaware limited partnership, for example, I can't participate in the management of or control of the Delaware limited partnership without potentially jeopardizing my limited liability. So, the default rule under sort of partnership law is all partners are sort of equally liable for the debts and liabilities of a partnership. A limited partnership provides a protection for that. But to the extent I exert some operational or management control, I could potentially jeopardize my limited liability. So, and that's a risk here. There has to be kind of a careful balancing of what level of oversight and control is exercised over the ultimate owner versus the potential risk of jeopardizing limited liability. And that's kind of where we get into, where you sort of want to chat with lawyers and accountants and various other people like that to make sure that you're maintaining your tax status of not being taxed at the U.S. level, while ultimately making sure that there's adequate protections in place to ensure that, somebody doesn't sell the building and make off with the funds without paying you what's owed. Now, again, the other thing to remember is that, for example, if there were, in the structure I described, you've got a BC limited partnership, which in turn acquires limited partnership units of a Delaware limited partnership, who ultimately acquires the asset. That partnership agreement is still a contract, right? So the partnership agreement of the Delaware limited partnership is still a contract, and that contract should include terms that deal with, how to, for example, if there is an event of fraud by the general partner, what happens? Do the limited partners have the right to remove the general partner? Terms like that. And, as a general rule, we have reciprocity of judgments as well. So, to the extent there's, we have multiple jurisdictions in Canada and the U.S. involved here. They're typically, if a judgment is sought for example, under fraud, it's generally enforceable in the other jurisdictions as well. Complexities to that, sure, but the key thing is making sure that the agreements provide adequate protection and make sure that the remedies are in place there to ensure, or the enforcement mechanisms are in place to ensure that either there is no opportunity for fraud, or if there is, what happens, and what level of oversight does the BC Limited Partnership have to ensure that it protects its investors, right?
Right. And all that detail is within the offering memorandum as well.
That's correct. Yeah. So there'd be a fairly detailed description of, for example, the ability to remove the general partner if it's for example, a Delaware LLC that's acting as the general partner of the Delaware LP. The sort of key terms of the operating agreement would be spelled out in there, together with key terms of the Delaware Limited Partnership Agreement that allows the limited partners of that partnership to, in certain instances, remove the general partner.
Got it.
It will all be explained in the offering memorandum.
Okay, wonderful. Jillian, here, the next question for you. I know you're not a tax lawyer, but let's briefly describe the depreciation when purchasing and managing U.S. asset, such as an apartment building, and how depreciation helps with tax savings for investors. If you'd like to kind of touch on the 1031 exchange as well, please go ahead. If you don't want to, that's fine.
Yeah, no. Okay. So no, I am not a tax attorney, but I will tell you right now that real estate is one of the best ways to almost shelter your income, because in the United States, and I don't care what anybody thinks about Trump, one of the good things that's come out of it is like the changes in the tax code, particularly for anybody who needs write-offs, because what he made possible, or what the law now is that you can invest in real estate and get all kinds of depreciation, but not just the depreciation that it used to be like every 27 commercial property was over I think 32, I might have these numbers wrong, but basically you depreciate over 27 years. But they came out with some new rules regarding bonus depreciation, where you can take a lot of the depreciation up front. So you basically take all your depreciation in year one. So you invest $100,000, you could practice, depending on the circumstances, you may be able to write off $100,000 on your taxes in depreciation. Yeah. So it just depends on the property. It depends on what you did. And it depends on if something called cost segregation is done on the property. A cost segregation study is done on the property where, and this is how I, by the way, when I personally invest, this is how I do all my investing. If a syndicator says to me, oh, I didn't consider cost segregation, I go, I'm out. Sorry, can't do it. You're not giving me all the write-offs I can get now. But what happens, and you mentioned 1031, what happens when that property gets sold? Well, you have to recapture all of those write-offs, right? Because now your basis, so if you invest $100,000, you write off $100,000, your basis in the property is $0. So what if you go and sell the property for twice what it was purchased for? That means what you should have coming back to is about $200,000. Oh no, now you have to pay taxes on $200,000, which is more than the $100,000 you were actually going to pay taxes on in the first place. We don't want to pay taxes on $200,000. So how can we, you don't avoid taxes, you defer them. And if anybody from the IRS is here, I only defer, I do not avoid. So what do we do to defer our taxes? We can do what's called a 1031 exchange. And we just do this over and over and over again, where we take that $200,000 and we put it into another property, and that's called a 1031 exchange. And thereby you defer your taxes. It's a great system for real estate entrepreneurs. That's why real estate is such a great asset, because you can do these things over and over and over again, and keep deferring those taxes and hold on to these investments for, generations to come. Now, do you have to eventually pay taxes? Well, there's a couple things you have to pay taxes on. If there's any income that gets shot off that property, when you get that income, unless it's set off by some depreciation or other expenses, you got to pay taxes on that. And eventually, if you pull any cash out, you're going to have to pay taxes on that. But in the meantime, if you're just like investing and your strategy is to hold on forever, or just be constantly invested into real estate and pull off that income as it comes out, what a great way to shelter some of your money.
Absolutely, and that's an incredible thing about Canada and the US is that, people in Canada, our tax laws are totally different. There is no 1031 exchange here in Canada. Depreciation is very difficult to organize, but for Canadian investors to be able to invest in the US, you have a country of over 300 million people, 330 million, very business friendly, great tax laws. So having you guys here is tremendous, truly, because we get to discuss all these items.
Okay, yes, Brendan, back to you here. Could you explain, there are licensed individuals.
Do you want to do this one, right?
Sure. Oh, yes, sorry.
Yeah, and I think Brendan has touched on this item before, but let's just kind of get it a little more detailed quickly here.
Of course. Okay, Brendan, can you explain to us, as far as Canada law goes, what are accredited and non-accredited investors?
Oh, okay. You can put me on the spot here without having the list in front of me, but
I can jump in. I mean, it's the 200K single person, 300K if they're married,
family, yeah.
On this, or if they have $1 million assets, not including their primary residence.
Correct. Or I believe it's 5 million, including their primary residence, can be liquid and non-liquid. There's a sort of description of financial assets, which gets at the liquidity question. But the most common one that's used is, particularly for sort of more retail investors, is $200,000. I believe it's in 2 of the previous 3 years, as stated on your income tax filings, or $300,000 household. So it's $200,000 for an individual, $300,000 household. Right. And the definition of accredited is expanded to include companies where the sort of primary shareholder of the company would, as an individual, would meet those tests as well. So,
company or one particular company?
Pardon me, sorry?
You said the shareholder of the company, is that any company or the company that's purchasing the asset kind of?
No. So if for example, my wife and I have a company through which we invest, we each own shares collectively. We qualify as accredited investors. We're the only shareholders of that company. So that company is deemed to be an accredited investor because its shareholders are also accredited investors.
Got it, great. And Jillian, same question for you. And just one item here for everybody listening. When Brendan is talking about dollar amounts, it's Canadian. When Jillian is talking about dollar amounts, it's USD. Yes. So please, Jillian, can take that away.
Yeah. So the United States, to be an accredited investor, you have to have $200,000 income as an individual, $300,000 a year as a married couple, or $1 million in net worth exclusive of primary residence. So whatever house you live in, you got to exclude that from your net worth if you want to qualify that way. And for entities, we have some thresholds for entities. It's like $5 million in assets. But if you look through, similarly, if all the owners of the company are accredited, then it can be considered an accredited entity. And we just had some changes to our accredited investor laws here in the United States, like literally in the last couple of weeks. Also, if you're a certain type of stockbroker in the United States, so if you have certain financial licenses, then you can also be deemed an accredited investor without any of the income or net worth requirements. So that's pretty much it. It's very similar.
Just it's USD and Canadian, so I mean the exchange rate right now, those are significantly different numbers. Okay, great. If you'd like to go here.
Sure. Okay, Brennan, back to you. Could you explain, there are licensed individuals who have the ability to raise capital for sponsors like us. I believe these individuals are called exempt market dealers. Could you explain more about exempt market dealers and the perimeters around them?
Yeah, so exempt market dealers are typically, they're well, for the most part, they work with individual brokerages, and they have various statutory requirements that relate both to their sort of pre-existing education, their ongoing education requirements, and probably most importantly, sort of suitability and kind of know your client items. So for example, when an EMD takes on a prospective investor as a client, they have to sort of, go through that investor's portfolio in detail, get a sense of their time in life. For example, a younger investor might have a higher risk tolerance, and that might be perfectly acceptable because they have a longer time horizon. Whereas if someone comes on board who's 63 and, has already built up a significant net worth and plans to retire in a couple.
All the people in their 60s are going to get upset if you say 73 or 83 these days.
But yeah, so I mean, those investors have different risk profiles, right? And different concerns about, short, medium, and long-term time horizons and things like that. So the EMDs have a sort of a responsibility to understand their client, to understand the risks of a deal, to identify whether a prospective investment is suitable for that particular client, and then to engage with issuers in a manner that ensures that their clients are provided with an adequate understanding of the prospective investment, how it aligns with their individual investment needs, their short, medium, and long-term risk factors, all those types of items. So they'll do their own due diligence on a prospective investor as well to ensure that investor, has a track record, has prepared, good investment documents, OM typically, to ensure that there's no risk factors that become red flags for the particular investor that they're working for, that sort of thing. So that's generally speaking an EMD's role in the sort of subscription process.
And a couple of quick questions here. I'll definitely do that. Give me a quick moment here. So would you, and this is kind of a question that just came to my mind now, going on that logic that a EMD, has the best of the clients in place and they've been trained and they're licensed through the province, through the government. Would you say for a passive investor looking to invest in a syndication or any kind of idea, do you think it's best to go through an EMD, or is it better to just go directly to the sponsor? So kind of it's similar to mortgage brokers who work for who are brokers, not work necessarily for one bank. You go to them, sometimes you pay a higher fee, but they get to kind of shop around for your mortgage price. So kind of give us an answer for that.
Yeah, so I mean, certainly working through an EMD is going to provide you with access to a broader range of prospective investments than a typical person would have on their own, just sort of going through their daily lives. And so there's an advantage that way. I mean, I think the EMD is a benefit for the obvious reason. His responsibility is to obviously to understand you and your needs and to try to identify prospective investments accordingly. And it's also, there's some protections because there are certain, like I said, statutory obligations on them to, to gather certain information, to keep themselves current as far as professional development goes, so on and so forth. And so there's protections for an investor that way. What we typically see is it's a very mixed bag. There are a lot of accredited investors for whom, for example, take the accredited investor category, right? There are a lot of accredited investors for whom it's very reasonable for them to be able to invest on their own without the benefit of a disclosure document because they have existing relationships, or perhaps they've worked in that industry, so they're very familiar with the risk factors, that sort of thing. And in that case, perhaps, dealing with an EMD doesn't add a lot of value to them. And so it's not necessarily worth the fees that are charged and that sort of thing. But I would say that that's relatively uncommon. It's more common that it's investors, whether they realize it or not, would be well suited to deal with an EMD who is, very familiar with not only this particular offering, but other comparable offerings and how that kind of aligns with your investment goals, with a subscriber's investment goals.
I totally 100% agree with you, and I appreciate all the help you've been giving us for the last few months as we've been in negotiations with our EMD that we've now signed with Token Funder.
Set in stone. We're so happy.
And the great thing is the executive decisions we've made is to send all of our investors through our EMD. So that's kind of a item that I wanted to mention.
Yeah, we'll be introducing our EMD on the next level.
Yeah, we're going to be having Alan on one of our webinars soon. Jillian, to you, Ava just spoke about this item, asked Brendan about this item. In Canada, these individuals are called EMDs. In the US, what are these individuals called, and or is there such permission for these individuals to exist in the US? And what do you guys call them, kind of?
Well, I'm assuming like everybody in the United States who's selling securities has got to be licensed. And I'm assuming that's I'm not very familiar with EMDs, but we have registered investment advisors who get paid by their clients, not by the issuer. So a registered investment advisor would advise their clients to invest in a deal, but the client would pay them. And then there's brokers or broker dealers, and they would get paid by the issuer a commission. They all have to be licensed on some level. You can't not have a license and sell securities in this country. As a matter of fact, it's a real problem. And a lot of people get in a lot of trouble because they don't understand the rules. And so then you have people who are paying the commissions and people who are receiving the commissions, people who are not licensed to receiving the commissions, and people who are paying it, who are paying non-licensed people, and they all can get into a lot of trouble. The reality is a lot of the private placement deals you're just simply not going to find through a broker dealer or through a registered investment advisor, because the rules are so strict and the liability is so hard for these for these licensed people that they don't want to take a risk on like individual syndicators or individual real estate funds most of the time. Occasionally you'll find them. So really in the United States, if you're going to find great syndication deals and fund deals, you're really looking to the sponsor themselves.
Got it. I think that's probably a significant difference, because a lot of sponsored teams here in Canada, syndicators, they do use the services of an EMD. So that's great that we talked about that item. Yeah.
All right. So yeah, I guess the incredible thing about having both you guys on is you both focus about real estate private equity.
Yes.
So it's truly amazing having both of you guys.
No, absolutely.
Here.
Yeah, both Brendan and Jillian have a focus on real estate, so it's great to kind of get their perspective because they're so versed in this realm.
Yeah.
I'll tell you guys a funny story. I've been communicating with Jillian for a while, and Brendan is our corporate and securities lawyer, and every once in a while I have a question from Brendan, and then I would call Jillian, and Jillian's like, no, that's not the way it works. Brendan's like, yeah, that's the way it works in Canada, so there's a lot of back and forth. So our incredible thing is, it's the first time I'm speaking to them at the same time.
Yeah.
So having them both on this webinar is truly a treat to get both perspectives and kind of get an understanding of both Canadian and US regulation. They seem to be very similar with certain differences, and it's great to have you guys on. So let's see over here. Yeah, so I mean, what I want to do is I want to have some of the questions from our attendees answered. The questions were coming in while we were going, so I'll just scroll up here a bit. Let's see here. So do you guys see the questions? I think at 6:40.
Can you guys see the questions? If not, I can just quickly.
I have some here. I clicked off of it. So let me scroll back up. Okay, you want me to start it?
We would love to get insight into requirements for having international investors, Asia, Middle East, Europe, and Canada. I know the answer to this, but I'll let the lawyers take it.
Well, from the United States perspective, it's the same, as Canada is the only country that I know of that we have a tax treaty with. So for any investors that are abroad in the United States, there's a couple things you have to worry about. Department of Homeland Security is one of them, and the other one is the IRS. Those are the two big ones. As far as investors are concerned from foreign lands, they're not as regulated under securities laws. The United States has an exemption called Regulation S as in Sam that is an exemption for foreign investors where you don't have to follow exactly the same rules as you do for American citizens, just because, the United States can't enact their laws, around the world as much as they would like to, but they can't. So, but we do have to worry about, as an American company looking to raise capital, is know your investor laws and making sure that your investors aren't coming from one of the T7 countries or aren't on, a bad actor list of some kind of,
Axis of evil.
Yeah, they just can't be on a banned list. And then the other part of it, of course, again, is that withholding, the tax withholding.
Great. And then at 6, we, as Americans, in order to invest in real estate in general in Canada. So yeah, this question is on the reverse. So I think I'll put it to both of you guys, Brendan or Jillian, is what do we need to know as Americans in order to invest in real estate or in general in Canada?
These are my lovely American.
I was going to say don't do it. Actually, as a general rule, we particularly in Vancouver, we have and BC, we have a lot of taxes that are levied on foreign investment in real estate, in particular in Vancouver and British Columbia. Now, it's a bit too glib because it depends on the ownership structure. It depends on various other factors, that sort of thing, to the extent these taxes apply. But there's certainly both a legal and political climate to sort of discourage foreign investment in British Columbia, generally speaking, although some similar taxes apply in Toronto and Montreal, elsewhere in Canada. So as a general rule, that's the case. Now, again, that's obviously much too simplistic of an answer. But in general, we tend to invest a lot more. My understanding is we tend to invest a lot more as Canadians in the US than Americans do in Canada. Not really sure why that is, particularly because we've obviously got a very strong real estate economy in Canada. certainly there's a lot of legal pitfalls. We have withholding requirements, just like the U.S. does when it comes to, for example, rents or, interest income, various other factors. So there's all those to deal with. There's sort of, foreign buyer taxes, foreign owner taxes, non-resident taxes, various things like that apply. And they tend to, a lot of them tend to be similar but slightly different. So it's the sort of number one piece of advice is, speak with a local lawyer to get a sense of, what sort of pitfalls there are if you're interested in investing in Canada.
All right, great, thank you. So the next question here at 6:53, do you guys see that? So in terms of advertising and selling these securities, what about non-registered third parties advertising online on behalf of an issuer? Are third parties allowed to do online marketing and refer potential investors to issuer and receive payments in Canada, BC, or in the US? So I guess the question is,
let me just clarify. You can always hire a marketing company to like market for you. Now, do you have an obligation to make sure that that marketing company is putting out the right messaging that's not deceitful? Absolutely. But the thing of it is they can't get paid based on they can't get transaction based compensation if they're not licensed. So if you want to pay them, $5,000 a month to do Google AdWords for you or Facebook ads or put up a website, go for it. That's marketing. That's not necessarily selling your securities. So that's where the difference lies. Is it transaction based compensation, or are they providing some other type of service?
Yeah, and it's very similar here. I mean, the sort of general rule of thumb is the person or the organization doing the marketing activities in the business of marketing securities? Do they receive compensation for selling securities? If so, then they have a licensing requirement, a registration requirement. Again, same sort of thing. There's nothing that stops anybody from, Google AdWords is a perfect example. There's nothing that stops anybody from hiring them to advertise this. But again, that needs to be sort of a, not tied to the success of selling the securities, the compensation paid to them, that is.
Got it. That's all for the questions. We didn't have as many questions as expected. Great. Okay, that's awesome. So
I wanted to quickly.
Sure, of course.
Let's see here.
Yeah, I mean, we had some other points we wanted to make. We kind of were wondering if you guys had some questions for each other.
Yeah.
Since now you have a Canadian lawyer in front of you and you have an American lawyer in front of you, if there was any kind of clarifications or anything you guys wanted to kind of get across.
I don't know. Is there any trick you can tell me to make me keep straight what the 33 Act is and what the 40 Act is? Because I don't think there's any Canadian lawyer who can remember which one is Investment Advisors Act, and the other one is the Securities Act. And every U.S. lawyer seems to refer to them as the 33 Act and the 40 Act, and I can never keep them straight. So
the 33 Act is when you're selling the securities, and then the 40 Act is okay. So the 33 Act is when you're selling the securities. The 34 Act is when you're reselling securities. So like the public marketplace. Yeah. And it also governs like brokers and dealers. And then the 40 Act is that Investment Company Act. That's when, okay, we're not just selling securities, but we're selling securities on the basis that we're going to go invest this money elsewhere. And the investor's making a decision here, and then we're making decisions for the investor. So that's really what the Investment Company Act, the 40 Act, is all about. I know it is confusing. I remember when I first started practicing law, I just completely ignored the Investment Company Act of 1940. Who needs that? I'm not doing any of that. And thank God I was only doing like real estate, so it didn't apply. But it would have really been a bummer if I did like some kind of big hedge fund and didn't pay attention to that.
Yeah, you had 100 advisors or 100 investors or something like that.
Yeah, I right now. So, but my question for you would be, what do we do about Regulation A in Canada? Because like you hear all kinds of different things that Canadians aren't allowed to invest in Regulation A's.
So what do you mean by Regulation A?
Regulation A is our like public offering. It's not a public offering. It's like an exemption from being totally public but you're allowed to like go out and raise money publicly and raise money from anybody. And last I heard, Canadians weren't allowed to invest in those.
So, and by public, you mean not necessarily listed, but just sort of a general offering.
Mm-hmm.
I'm not familiar with any sort of restrictions.
Oh, well, then
on
I'm going
that.
to carry on. No, I'm just
Yeah.
Ignorance of the law is not an excuse. Don't even follow what I just said
Yeah,
there.
yeah.
We're hearing a lot of each other, so because you got to be representing us in the U.S., Brenda represents us in Canada, so be ready for that. So just a final question. We were planning for an hour, and we really appreciate your time. But just a final question here for you guys. If you had, and you know, anybody can go first. If you like, Jillian, you can go first. If you had one advice for investors looking to passively invest in real estate syndications, what would that advice be to an investor?
If I was giving advice for people to invest in a syndication,
It's like what to watch out for, the do's and don'ts. Like what would be the
What's the number one advice that you give?
the number one advice is you want to always make sure the corporate documents match whatever they're saying in the private placement memorandum. And you want to make sure there's nothing hidden. Like if they're saying that, read their use of proceeds carefully. Where is money coming from and where is it going to? Have they accounted for everything? Have they thought of everything? Are they painting like too rosy of a picture, or is it the true blue what's actually happening and what could happen? But the big thing for me is to make sure that those corporate documents match what the PPM is saying. I've found more times that investors will read the offering memorandum or the PPM and not read the corporate documents, and then get, sideswiped later when they realize, wait, the corporate documents are what rule, not the offering memorandum, and they don't match. And now we're all in litigation over what I thought versus what was true.
Yeah,
All right.
nice.
Thank you. And Brandon, if you like, same question for you. What would be your number one advice to investors looking to invest in these types of syndications, apartment syndications in the U.S.?
My advice would be a little bit, it would be partly legal and partly sort of more practical, which is the most important thing to me is to look at risk factors in a PPM or an offering memorandum to first get a sense of whether or not the sponsor has sort of really put some thought into understanding what could possibly go wrong. And then that's sort of part A, and part B is then understanding kind of from a budgeting perspective, from a modeling perspective, have they potentially factored some of that risk into their analysis to make sure that that they've set aside, sufficient contingency reserves or what have you, so that they, when the unexpected happens, which it always does, they've planned in advance for it, right? So that's sort of my key advice.
Great. And another quick question to yourself here, Brandon. If a Canadian sponsor, a team here in Canada, is looking to start basically what we're doing to partner with Canadian investors to invest in the U.S., at what point should they get in contact with you? Should that be super early, like I did, like years before, or kind of give us an idea about that?
There's no magic answer to that question. I mean, certainly, generally, the earlier the better. But really, what's most important is to make sure that at the provincial level, at the BC level here, that a lawyer is engaged in, before anybody's signing any subscription agreement to a U.S. partnership or becoming a partner of a U.S. partnership, and really kind of get understanding what level of control can be sort of negotiated into that U.S. partnership agreement and that sort of thing, because there's all sorts of both legal and business risks that flow from simply trying to sign on to kind of an off-the-shelf partnership agreement that's done in the U.S. and without kind of,
negotiating
certain key terms into it. So.
Okay, wonderful.
Awesome. Yeah. So
are we gonna tell Jillian our secret here?
Yeah. We are. So Jillian, we're huge fans of you.
We're huge fans.
For people who are not familiar with Jillian, she is. She's huge. She's got a huge platform online. She has
podcasts,
the War Room.
Incredible advice.
Just amazing content, and they, videos, YouTube, podcasts, and she's on many different webinars and many different online events where sponsors host. And so I've heard about Jillian for years now.
She really knows her stuff.
She really, every time I watch one of her videos, I've learned something new because she's very up to date on recent information as well. So Jillian has an event coming up, and what we'll do is
we'll post it again on the comments here, and we'll share it with all of the attendees. But you guys want to go to this one?
Yeah. So actually, what I want to do is I'm going to email your event to. We're going to be there ourselves to all our attendees tonight. Also, people who signed up, that we're going to be sending the replay of the video. We're going to add your event. But if you like, please kind of if you like, tell us on the event, please. Yeah.
No, absolutely. I would love you guys to come. And honestly, I gave August a special link. So I click on that link because it's a flash sale. So it's multifamilywarroom.com and check it out. We got a couple of special speakers, but we're going to talk about how to raise money for your deal. I'm going to talk all about how to raise money. I'm going to teach you guys how to raise money. If you're looking to raise money, I'm going to teach you how to do that. And then I'm going to also do a segment on if you're a passive investor, what to look for in offering documents. I'm super excited about this event. I haven't done an event that I've put together myself. You know, I usually attend other people's events. I haven't put together an event that I've put together myself in over like 2 years. So this is like my baby right now. So I'm very excited about it.
I can't wait. You're gonna rock it.
And that's why as soon as I heard that, because every time she's on any kind of events, I make sure to watch it.
You're so sweet. I'm gonna
make sure I'll see Jillian's portion.
Jillian, we're like taking screenshots and
yeah. I have a lot of screenshots from your PowerPoints that you present.
Oh, that makes me so happy.
Well, since you have your own event, and also another great thing is my personality. So I'm usually very dull on these webinars, and everybody's like, "Come on, you do that your personality. Come on, this is not who you are." She's like, "Look at Jillian. She's so lively. Be like her." I'm like, "Okay, you're right. You're right."
Can you please take some notes on that? You did great, right? You did great, Jillian.
Yeah, no, I mean, we're not saving lives here, but we are building lives. And so I think there's a lot of reasons to be happy, you know? So,
I'm so excited about this.
Yes.
Yeah. So I really, I encourage everybody, use the link that I gave August because there's a huge discount on that link, and we're doing a flash sale for Labor Day. So sign up tonight, guys, and we'll see you there, and then let me know you're there and say hi. So
wonderful.
I can all you awesome people.
I'm going to share it right now. It's the one that has my last name on it, right?
Yes.
Okay, I'll share it with everyone now.
Yeah, use that.
So please, everyone, kind of get on here and.
Or I mean, you guys could just go to the website and pay full price too. That's fine. Either way works for me.
Wonderful.
So I guess we've hit an hour and a half. We're so grateful that you guys took the time to come here.
Oh yeah. No, I saw you guys know how to promote. My goodness. I saw this webinar everywhere. I got really excited about it. I actually put it on my calendar 3 times because I was like, I cannot forget this. These people are promoting hard. I love it. And I'm so honored that you had me here with Brendan.
Thank you so
Brendan,
much.
it's lovely to meet you. It's always good to, I can't tell you how many times somebody asks me if I know a Canadian attorney, and now I can say yes.
Absolutely. and believe me,
Very nice.
No, for sure. Brendan comes, very much advertised by us. He's taken care of us. He's been great. And definitely, if you have any kind of clients looking to do any kind of business here in Canada,
I will. Well, anybody, if you guys need to reach me and you have additional comments or questions rather, that you think of, because this always happens to me. People get off a webinar and then they go, I wish I asked X, whatever X may be. You can just email me, Jillian at jilliansidoti.com. It's just my first name at my first name, last name.com, and I'll be happy to answer them for you.
Thank you.
And again, we'll send an email to everyone, including your guys' information and contact and the event that you have coming up.
Yeah.
We really hope to have you guys on again at some point. And thank you for being here on your long weekend. Thank you, everybody, for watching. And have a wonderful rest of your long weekend, everyone.
We appreciate you all.
Bye. Thanks,
Thanks.
guys.